I'm gonna tell you exactly how I used to invest. I'd open my brokerage app, see red everywhere, and my brain would just snap into this mode of, okay, we must do something right now. No plan, no numbers, just my hand hovering over the sell button like it's a self-destruct switch. And that moment is how people with perfectly good investments end up with terrible results.
Because the market doesn't just test your portfolio, it tests your decisions. And it's really good at waiting until you're tired, stressed, maybe it's late, you're in bed, and this is the last thing you check on your phone. That's when smart plans get abandoned. Quick note before we go on. This is education and entertainment, not personal financial advice. There are no guarantees. All investing involves risk.
Most people don't lose money because they picked the wrong investment. They lose money because this moment, the red screen, the fear, the urge to act, makes them sabotage a plan that actually would have worked. I've done it more than once.
So today, we're building a plan that still works in that moment. We'll start with a simple baseline using SPY, something you can understand in one sitting and repeat for years.
And then we'll show you an optional seatbelt called the 200-day moving average rule. It can reduce the worst drops, but it can also lower returns a bit because you sometimes miss rebound. So we're not hiding the downside. We're showing you the trade-off.
So here's the real question this video is about. Do you want the hard way, where every red day turns into a decision?
Or the smart way, where you follow a rule and stop touching things? Because the hard way gives you drama today and regret later.
And the smart way feels boring, even when it's working.
Which is exactly why it works for most people.
So if the goal is to stop hurting ourselves in moments like that, the plan has to be simple enough to survive them. That's where the baseline comes. The baseline starts with one thing, SPY. SPY is an ETF that tracks the performance of S&P 500. Think of it as one purchase that gives you a small slice of 500 of large US companies all at once. No stock picking, no predictions, no trying to be smarter than the market.
Translation: you're not trying to be a wizard, you're just trying to own the economy and let time do its thing. Because in real life, money doesn't politely wait to be invested. Your paycheck hits and immediately gets jumped. Rent, groceries, car insurance, some subscription you forgot about. There is no quiet moment where your money goes, ah, yes, now I shall invest.
Which is why I'll invest later almost never happens. This is where automation matters. If investing is optional, life will vote no every single month. Automation makes the decision once, so you don't have to keep making it.
Because if it's up to me to remember or to feel motivated or to wait for a good time, it's not getting done. Automation isn't about being disciplined. It's about removing the need for discipline.
So this is the framework we're going to keep coming back to. 3 things you actually control. First, time horizon. This is how long you stay invested. Second, contributions. How much money do you add every month? And third, the behavior, whether you panic or get stuck with fear of missing out, or do you stick to the plan? That's it. It is simple, but it isn't easy.
Notice what's not on that list. Predictions, headlines, and hot tips. Most of the work is just showing up and not sabotaging yourself.
If you automate contributions into a broad index ETF like SPY, you've already done more than most people ever do.
And it's boring, which again is the point. Okay, so if the plan is simple, here's the part that messes with people's heads. What does this actually get you? Because nobody wakes up excited to automate contributions. They want to know if this stuff really works.
This is compounding, and the uncomfortable truth is, it looks boring for a very long time. The line moves slowly. In fact, it moved really slowly in the beginning, till one day it starts bending upward. That is the point where your money has started making money for you. That is the first step towards the transition from wage slave to capital allocator. But this bend only happens if you stay invested long enough and accumulate enough of a capital base for it to start mattering.
This is the part where people quit. Nothing's happening. It feels pointless. You start wondering if you're doing it wrong. So they stop right before it gets good. This reminds of the internet meme of someone digging to find diamonds and then turning back just before they hit the treasure. You don't want to be that guy.
When you zoom out, getting to 1 million isn't a trick problem. It's a calendar and patience problem. It is a problem of keeping our emotions in control. Time plus contributions do most of the work. Short timelines with small contributions. Those bars are basically zero.
Which is why I just need one big win sounds tempting. But that's not investing. That's hoping, and hope is a terrible plan.
This chart is important because it shows something people ignore. You're not choosing just an average return, you're choosing a range of possible endings. Some end great, some end badly.
And you don't get to sample all of them. You get one ending, one life, one result. That's why higher returns always come with uglier stories attached.
This is called risk of ruin. It means one bad strategy or one bad reaction can erase years of progress. Once you're reset, time has to start over.
That's the real enemy, not missing the next big winner, not being too conservative, getting sent back to start.
So the goal isn't thrilling returns, it's staying in the game.
It's staying in the game long enough for boring math to work.
So if you've automated SPY, stayed consistent, and given it time, the math should work.
Should being the keyword, because reality loves to test your patience.
Here's the first lesson. Pick what you can actually stick with. The portfolio you can survive emotionally is the one that matters, not the one with the biggest projected return.
Yeah, I learned this the hard way. I once went all in on a super aggressive growth mix, and it crushed me when the market hiccuped.
Most failures aren't math failures, they're human failures. Lesson 2. Drawdowns are not theoretical. They show up right when you're tired.
And if you don't know what normal looks like, you'll assume it's game over.
Drawdown equals peak to trough. In other words, the deepest your portfolio falls before it recovers.
Translation: how far did it hurt? And how long did you stare at that red number wondering if it's game over?
Knowing this number ahead of time is powerful. It helps you plan your contributions and your emotional armor. And here's the real villain, the behavior gap. Even a solid plan fails if you panic, chase the next hot strategy, or sit in cash waiting for clarity.
Been there. I once sold everything because of a news headline, missed the rebound, and my safe plan got wrecked.
Recognize this is human nature. The enemy isn't the market, it's us. So what does that mean in real life?
So we've seen why even a solid SPY plan can feel like a roller coaster, right?
Exactly. And this is where the 200-day moving average comes in. Think of it as optional insurance, not a crystal ball. Not a magic shortcut, just a rule to reduce the worst drops. The 200-day moving average is simply a smoothing filter. It follows the long-term trend, ignoring short-term noise.
Translation: it helps you stop reacting to every wiggle your app throws at you at 2 a.m.
It's not predicting the future. It just says the trend is up, the trend is down. So you can make a rule around it. The rule is simple and repeatable. When price is above the 200-day moving average, you invest. When price is below the 200-day moving average, you protect or hold. When price crosses back above the 200-day moving average, you re-enter.
No guessing, no checking the news, just follow the line.
Structure, not prediction, is the key idea. Why people like it. Look at the worst drops. Baseline max drawdown, minus 52%. Now compare that the drop down with 200-day moving average, that is minus 19%. Not ideal, hell of a lot better than minus 52%. A difference between I feel a niggle versus I am having a heart attack.
Smaller craters, way easier to sleep at night, and easier to actually stay invested.
But in investing, nothing is free, ever, really. Sometimes the signal flips and you step out, then back in at the worst time. That's called whipsaw. It's the cost of protection. And here's the trade-off. Baseline grows higher over 30 years. 200-day moving average ends a little lower because it misses some rebounds.
Basically, your seatbelt might slow you down a little, but it keeps you safe.
Think of it like insurance. You pay a premium, slightly lower returns to survive the crashes intact.
Seatbelt analogy. One crash avoided can save decades of stress.
This doesn't make you richer, it makes you steadier.
And in investing, staying in the game is half the battle. So we've survived the red zones, met the seatbelt, and learned why panic is the enemy. Now, what do we actually do?
Here's the simple truth. You have two valid paths, and both can work. Option 1. Baseline SPY, buy, hold, automate, repeat. That's it.
Option 2. Baseline plus 200-day moving average. Same plan. But you step out when the trend turns down and step back in once it's safe.
Tonight, do 3 things. Pick a monthly contribution you can actually stick with. Automate it into your SPY ETF. Write a tiny red screen rule to stop panic selling. Something like, I follow my plan. I do not sell out of fear.
That's it. No complicated hacks, no chasing hot tips, just consistency and survival.
There's no perfect choice here. Both paths can work if you actually follow them.
Consistency beats cleverness. You don't need to be a wizard, you need to stay steady. That's the real magic.
Next time, we'll cover weekly rebalancing, how to keep your portfolio aligned with your risk without predicting the market.
Basically, your portfolio behaves like you want it to, instead of shocking you every time the market farts. Right now, I know exactly what to do, and I don't need to overthink it.
Set it, forget it, and let time do the heavy lifting. That's one way to work toward $1 million without losing sleep.
And that's the plan. No drama, no panic, just repeatable, boring, unstoppable steps.